So earlier this week, Blackstone's REIT announced a $1.6 billion recapitalization of the LBA Logistics industrial portfolio, consisting of 71 properties and over 9.5 million square feet of industrial space, marking the continuation of what has been a red-hot last 12 months for industrial property owners. The recapitalization brought Blackstone REIT's industrial portfolio allocation to over 35%, and with the largest commercial real estate owner in the world taking such a big swing on one product type, you can be pretty sure that there is some compelling data driving that decision making, and that spells positive news for the industrial sector as a whole. But on the other side of the spectrum, with so much growth in the industrial space in recent years and so much popularity and buzz among commercial real estate investors driving down cap rates and propping up property values in the industrial sector, the question is there still room to run for investors looking to get into the industrial space? And if it isn't too late to get in on the party, what should commercial real estate investors be looking for in industrial deals in 2021? So industrial has really been dubbed the belle of the ball for years now by commercial real estate investors, and with the growth of e-commerce and shorter delivery expectations continuing to drive warehouse demand higher and higher every year in most major markets across the United States. According to Cushman and Wakefield research, U.S. industrial vacancy ended last year at just 5.2%, with markets like Orange County, California, Nashville, Central New Jersey, Los Angeles, and Boise all posting vacancy numbers of less than 3% in Q4 of 2020. Industrial rents also ended the year at a record $6.38 per square foot per year, according to Yardi Matrix, which represented a 4.8% increase over December 2019 figures, and markets like the Inland Empire, Los Angeles, Boston, and Seattle all saw year-over-year rent growth of over 6%. Now, this is all good news in the near term for industrial investors, but with supply staying relatively low and rents increasing, to capitalize on the demand that has really exploded over the last several years, developers have started to jump into the industrial space at a record pace, which could spell a slightly different supply story than we've been seeing in recent years in 2021 and beyond. Just last year, a record 228.4 million square feet of industrial space was delivered in the US, which was the highest number on record in the last 20 years. And as far as product that is coming online in the near future, the current industrial pipeline has jumped to over 360 million square feet, which also represents an all-time record high, and over 337 million square feet of that figure, or 93.5%, is slated to be warehouse and distribution space. And what's interesting about these numbers, and what could potentially be somewhat alarming for industrial investors going forward, is that only 43% of this space is build to suit, or building for a specific tenant to occupy immediately, which leaves over 57% of that space as speculative development without a tenant in tow. So with industrial supply about to increase at a record clip and property values staying the same or even increasing relative to NOI values in many US markets, this leads to the question, is industrial still a good investment opportunity heading into 2021? And if you are an investor looking to get into this property type, what should you be looking for, and what is the data telling us right now? Well, first off, the first thing that investors should be aware of, and probably one of the most surprising points on this list, given how some other commercial real estate product types are performing in these markets right now, is that for the most part, industrial rents are increasing where people currently are, not necessarily where people are going. In their January 2021 National Industrial Report, Yardi Matrix found that primarily highly populated, high cost of living cities actually saw the highest year-over-year rent increases in industrial space from December 2019 figures, with metros like Los Angeles, Seattle, the Bay Area, and Denver all topping the list. And these heavily populated, high cost of living markets are the same markets which are making the news right now for the largest multifamily rent decreases in the last year, with the Yardi Matrix National Multifamily Report from December of 2020 showing those same metros, including San Francisco, San Jose, Seattle, Los Angeles, and Boston, all seeing some of the sharpest rent declines in the country, with many of these markets seeing multifamily rent decreases of over 6% year over year. So even though right now many secondary and tertiary markets are seeing their populations growing and multifamily rents increasing significantly right now, it appears as though the growth of e-commerce demand has shown up at its highest in already densely populated cities, even with potentially negative net migration numbers present in many of these metros. A few select markets have seen a strong combination of both multifamily and industrial rent growth, including markets like Phoenix, the Inland Empire, and Atlanta. So these could be a few diamond in the rough sweet spot cities that investors should keep their eye on for growth potential in the near future. But for the most part, the data is showing us right now that densely populated, high cost of living metros are seeing the most potential for rent growth and NOI growth in the short to medium term in industrial space. Now, aside from the specific location of industrial demand for the industrial market as a whole, investors in 2021 should also be watching for supply increases outside of just ground up development coming online that could slow rent growth unexpectedly. So like I mentioned earlier on in this video, record high ground up development numbers are being posted across the US today, but the big question mark here is how much retail conversion to industrial space is going to contribute to additional supply in the market. Recently, CBRE released a report called the Future Hybrid Store, which detailed out the potential effects of industrial becoming a major part of current retail space and the use of current retail storefronts as last mile fulfillment centers for online orders or spaces that provide pickup and shipment services without an in-store shopping component. Online sales have grown by an average of 16.4% each year since 2010, according to that CBRE report, and brick and mortar retail sales have grown by just 3.1% per year during that same period. And with that, many vacant retail sites that are already located in these major metros seeing a supply shortage of industrial space in the market represent a huge opportunity for investors to repurpose these sites into an industrial use. And if investors do end up flocking to these types of opportunities, this will inevitably increase the supply of available warehouse or distribution space in the market in a way that currently really isn't being reflected in many industrial supply projections over the next 12 to 24 months. So while the 8+ million people in New York City are making online purchases more than ever before, many of the distribution centers that supply these consumers are still located in the outskirts of Brooklyn, northern New Jersey, and Staten Island, and the repurposing of existing retail space in Manhattan itself could be a major play for industrial investors this year. And if this catches on and opportunistic investors find that this strategy is both feasible and profitable, the already record high square footage of new industrial space in the pipeline will end up climbing even higher with additional converted space available, which could start to produce some downward pressure on rents in a way that most industrial investors aren't expecting when they're going into a deal today. And finally, aside from being aware of where supply is headed and how demand is currently shaping up across the country, the final point here that industrial investors should be looking at right now going into a new deal is that not all industrial properties are created equal. Right now, storage and distribution space is what is in the highest demand across the country, and with that, this type of industrial property has the most opportunity for rent and value growth today. And this is especially true for certain subsectors of storage and distribution space, including sectors like cold storage, which have exploded in popularity over the past year with a significant growth of things like pharmaceutical and grocery delivery. But on the other side of the spectrum here, there are also industrial users which have actually seen a decrease in activity over the last year that might not bounce back well heading into 2021. Certain manufacturing plants and distribution centers supplying major live venues like sports complexes, movie theaters, and airports all represent somewhat of an unknown risk to industrial investors. And with this, it's really important to go into an investment with eyes wide open about the business that each tenant in an industrial space serves and whether that business is expanding or contracting over the near and long term. The key here overall in the industrial product type as a whole is that even though this asset class is the star of the show right now, there are some clear winners in the space that are poised for growth and other subsectors and markets that might be laggards heading into this upcoming decade. And doing your research first around demand in the market, repositioning efforts of retail space, and the business and financials of each tenant in a property is going to be key in finding the best industrial opportunities in the new year and not getting caught up in all the hype that is around this part of the industry today. And if you're looking to buy or develop an industrial property this year, or you're looking to land a job as an analyst or associate at a top industrial investment or brokerage shop and want to brush up on your modeling and analysis of commercial properties, as always, make sure to check out Break Into CRE Academy, which is going to give you instant access to courses on how to build an industrial acquisition and development model from scratch in Excel and how to value commercial real estate properties based on your own investment goals and targets. Also, let me know in the comments what you see as the biggest opportunities and potentially the biggest risks for industrial investors going into the space today. And if you like this video and want to see more content on the different real estate property types and the state of the market for each, make sure to hit the like button on the video so I know you want to see more content like this, and subscribe if you haven't already so you don't miss any new videos as soon as they're released on this channel. So thanks so much for watching, guys. I hope you found this helpful if you're looking to get into industrial real estate this year, and I'll see you in the next video.